Does anyone else want to buy stocks, but they're pressed by the issue that stocks just keep going up and up and up? You may feel like stocks are expensive, but I want to be a buyer. What do you do in this circumstance? And are there some stocks that may not be so overbought like the broader market? Well, in today's video, my goal is to share some stocks that I'm watching with you in this market today. Let's jump in. And just before we get into some individual stocks, I also wanted to show you guys this trade that I have on, which is essentially a long call vertical on the VIX, the volatility index. And the reason I have this on is because I do think that the markets themselves are a little bit expensive. And so to hedge my risk, I am also buying a little bit of VIX calls because I think they're really cheap right now. If the market were to roll over at any point here in the next few weeks, my VIX verticals could potentially cash me out or hedge me a little bit to downside risk that I think there may be in the markets at this time. And I've had questions on the channel about companies like Palantir. Should I be buying Palantir's dip here? This is, already turned into a about 12, 13, 14% dip in the stock. Is this an opportunity to get long? Well, I hate to sound like a boomer here, but my answer is definitely no. Now, again, the stock may keep running and it's very hard to call, Goldilocks, darling stocks like this. It's very hard to call a top on them. However, to me, the risk to reward on a company like this is simply not attractive enough. When we take a look at the stock analyzer, which helps us to look at a whole set of financial data points, you can see that Palantir is just incredibly expensive. A 580 PE ratio with a forward PE of 204. What that tells me is that investors are paying a huge premium to tap into the potential future earnings of Palantir. And the challenge for me with a stock like this is that, is it a great company creating a really cool product? Yes, I'm a big fan of the company and what they're doing. But that does not necessarily mean that the stock is a purchase that I'm ready to make. In fact, if I look at the weekly chart, this is a stock that I would love to get a chance to pick up. If it were to fall maybe back down into, under $100, there may be an opportunity to scoop up some shares for the longer term. But for me, that is what it would take for me to start buying a stock like this, because I'm not a momentum, kind of high flying stocks type of buyer. A similar company is AMD. This is a company that, again, is priced very, very richly, but maybe for good reason. I mean, these companies are great companies. And I once heard a great analogy, essentially, where, 100 years ago, a key, highlight level real estate in Manhattan was also really expensive. And it got way more expensive than it was then, right? So there is that debate when it comes to expensive stocks. They can, of course, get more expensive. We take a look at like a Netflix is another expensive stock. So there's just too much stuff out there where it's just the price does not, the risk to reward profile just does not look great to me. One that's really easy for me is Google. I've talked about this a lot. I am an owner of Google. I own a good number of shares. I'll show you my position there. You can see I own 200 shares of Google, but I've also got some call options that I've sold against my shares. This is what is known as a covered call, where essentially I sold the $215 strike price calls for the September 19th expiration date. I'm floating a little bit of gain on this as the stock has gone sideways to down, which means that those options are losing value. And because I'm short the options, that is a advantageous thing to me. I also sold right before their earnings report a $165 strike price puts. Those are likely to expire worthless. In fact, they do in just 3 days. So I'm pretty much just letting those expire for the full 100% gain of around $300. Another stock that I think is definitely not overbought and definitely not overpriced in, relative to its own history would be PayPal. Take a look at PayPal, which was an absolute darling stock a couple years ago that completely lost its favor with Wall Street. I actually remember a point where this was a big stock on the heat maps out there, and now it's just a very small company compared to what it once was. But despite that, the income statement for PayPal continues to rise gradually. So do their net income and net margins. They have decent revenue and earnings growth, and their valuation is very realistic compared to their 3-year average. I currently own 400 shares of PayPal, and if it were to give me a dip, especially if the broader market made a move lower, it would probably be something I'd be looking to scoop up more shares of. Another stock I've been watching here recently is Chipotle, ticker symbol CMG. This is Chipotle Mexican Grill, and the stock has gotten pretty hit hard here recently. Take a look at the weekly chart. On a long-term basis, this stock has performed really well, and recently is pulling back to not only what I believe to be an oversold stock price level, but coming into contact with some longer term levels of support if the stock continues to move lower. Take a look left and you can see we've got this $38, $36 key level of support. And we also have some support around current levels here where I think we may continue to see some sort of a bounce. But I think the stock is a little oversold here. And I actually took the opportunity during this to do a bullish position via options by selling a cash secured put. Today's video is sponsored by Moomoo. And if you haven't heard of Moomoo before, they're a one-stop global trading platform with over 26 million users across the US, Australia, Singapore, Canada, Malaysia, and Japan. And Moomoo offers $0 commissions on stocks, ETFs, and options trades. They also offer free level 2 data and real-time options chain data, no extra charge. And the Moomoo platform is super advanced. They offer a really powerful options trading tool, and you can even track latest public figures holdings like Nancy Pelosi's directly within their portal. And if you want to learn something about a particular stock, just ask Moomoo's AI feature. With this tool, you can ask for trading insights on your favorite stocks. And if you want to tap into what institutions are buying and selling, check out their institutional tracker. This tool allows you to explore top institutional holdings. What sets Moomoo apart is their incredible platform for researching stocks, checking out all sorts of different analyst rating tools, and insider holdings and trades. And for a limited time, as shown on the dates on the screen right now, you can get up to $1,000 in NVIDIA shares, plus 8.1% APY for US users. As you can see on the screen, please follow the criteria here and make sure to use the link in the description to get the full context behind this offer while it is available. It is available for only a limited time. And are you already trading with another brokerage, but all these tools sound pretty cool? Well, I think so too. And they're currently offering a really cool 3% match on the first $1 up to $20,000 transferred from another brokerage. So if you're looking to take your trading tools to the next level, check out Moomoo and take advantage of some of the offers available using the link and details in the description of this video down below. Now back to the video. Here's a look at Chipotle on the daily chart, which has moved far away from its moving averages. And I also think that when we take a look at the options contract I sold, the 26th of September puts, the strike price being $45. So the $45 strike price, which is just around current level. And what I love about options is you can see the stock has actually dropped below the strike price. It's in the money currently, yet my options position is also profitable. What's cool about this is if I had just bought the stock, I'd be down on this position. But because I sold puts and some time has passed since I did so, the options contract have lost value, meaning my profits are actually going up, even though the stock is going sideways from when I sold this put. If we do get a bounce back in the stock, I'll take this as an opportunity to take a trade. And if this thing continues to go sideways, I may roll this put contract lower in strike price. If you're unfamiliar with rolling options, I actually did a video on the topic here recently on my channel. In fact, I did several. So if you're interested in options, we'll share a playlist in the top right hand of the screen where you can find out more about options. Chipotle continues to be a crowd favorite amongst young people especially. I don't know about you guys, but I love my chicken and rice bowls. They're just delicious and relatively healthy compared to other places. And you can see that overall, this sector, this industry, I should say, has been really getting beat up. We've seen a lot of the restaurants out there underperforming, but we do also see rising revenue and rising net income. Their profit margins seem to be holding up okay, and I like that a lot. You can also see that when we take a look at the earnings report tracker within the stock box, for the last 4 quarters, Chipotle has been beating their expectations. The yellow line that you're looking at, that represents the earnings per share estimate that analysts had for the stock, and the green bar is what actually came out. So earnings per share, they met their expectations in the latest report. Prior to that, they beat them slightly, then they met them, and then they beat them. So while not a massive beat by any means, the stock's earnings are still holding up, but the stock price has dropped significantly. You can also see when we take a look at the stock analyzer page for CMG, we have a trailing 12-month PE that is below its 3-year average. Same thing with the forward PE. And I do think that restaurants are going to turn around at some point. And when they do, I think Chipotle will be deemed oversold. Of course, if the broader market has a recession, as always, most stocks will drop significantly, and Chipotle would not be exempt from that. But I do think that the restaurant industry as a whole is kind of experiencing a couple rough months, especially with all the tariff drama and stuff. But I do think that that eventually will roll away, and that great companies like Chipotle will actually rebound very nicely. So with the put contract that I sold on Chipotle, if the stock continues to go sideways or down and is below the strike price of $45 by expiration, that would mean that I get assigned 500 shares. Since I did 5 contracts, I would need to buy 500 shares of Chipotle at the agreed upon strike price of $45 per share, minus the premium that I collected of $2.42 per share. So my average entry price would be around current levels actually. Remember that when you get assigned after shorting a put, you actually get assigned the stock price at the strike price minus the premium collected. This allows me to enter stocks with less risk and by also getting them at cheaper prices. And if you guys are interested in using the tools that I'm using in my videos to analyze stocks, this stock box is a tool that we're working on really hard behind the scenes here at my company, A1 Trading, and we're offering people the chance to try it for 30 days right now. If you're interested in checking out the stock box, make sure to use the link in the description down below to sign up for a trial and get information on how you can access the tool, explore all the financial data that we have, as well as the new institutional tracker tool that we just added to the stock box. This tool allows you to track individual institutions and what they've been buying or selling quarter by quarter. If you want to see what major players are buying in terms of individual stocks or what they're selling, you can track that all within our institutional tracker within the stock box. So try it out for 30 days down below in the description, check it out and see for yourself. Now back to the video. Here's an updated view of Tesla, which has been very choppy here recently, but has been a great income producer for my portfolio. I own 400 shares of Tesla, which admittedly is a lot and a little bit too much for my portfolio. So what I've done is I've sold 2 different strike price calls out about 45 days initially when I sold the calls. I sold the $400 strike price for the 19th of September and the $355 strike price for the 19th of September. What I'm doing here is I own the shares, and this is classic wheel strategy stuff. Essentially, I bought the shares via selling cash secured puts. Now I own the shares and I'm looking to sell out of the shares if the stock price catches a bid. So if we move beyond $355 per share at or before expiration date of the 19th of September, I could get called away from my shares and would experience a profit of about 40 to, well, let's call it 46, 47% on my shares when it comes to, I'm sorry, this one, right? The $355 strike price. I would experience about a 46%, let's call it 48% gain on the underlying shares, somewhere in that range. But I also collected $8.89 per share in premium for selling these options. What's beautiful about this is I've actually been selling calls against my position for several months now, and I've collected some really good income on shorting calls on Tesla. So if we do get a move to the upside, I'll take those profits and the premium collected, pocket it, and move on to the next trade. Another sleepy stock that I've been doing this on is ExxonMobil. ExxonMobil has not moved very much here recently, and you can actually see I am down on my shares just slightly. I've held them for some time. I have collected some dividends in the meantime from this stock, which pays out dividends quarterly, and I've also been selling calls. So I've sold the 110 calls here out to the 26th of September. I collected $1.59 for doing that, times 200 shares. If ExxonMobil has a big move lower, this is almost always a stock that I add a little bit of share to in my portfolio. And if the stock rises, I'll usually just take a profit, making it an excellent candidate for the wheel strategy, where I sell cash secured puts to get into stocks, get assigned eventually, and then sell covered calls to get out of the stock. Here's a look at a lot of my different positions on right now. I have some, I still have my position on Robinhood. I have my Delta Airlines, which is now in the money. We can take a look at Delta Airlines. Stock has done really well, and I sold calls around the $55 strike price. This is the second time I've sold calls against my Delta Airlines position. So I've collected some income a couple different times, and it looks like this time I am likely going to get called away. I'm just going to let the shares go and take a profit on this trade. You can see the open P&L when considering the short call position that I'm taking a loss on, but the gain on the share price will net to somewhere in the neighborhood of around $11,000 profit. This, like ExxonMobil, is often a trading vehicle for me, meaning if the stock drops a lot, I usually will try and pick up some shares for later. But when the stock is up, this is just not one of my favorite companies to hold for a long period of time. Here's an update on my position on Nvidia. So I own shares, the stock price has gone sideways, and recently I sold calls for $1.38 per share. Since I have 500 shares, I did 5 contracts at $1.38. So that's $1.38 times 500 shares that I sold calls on to collect $690. Currently, the position is floating of that max possible $690. We're floating 420 of it. I may just take the profits here pretty soon on this one. Alternatively, what I could do is roll the options contract out by right-clicking here. And by the way, the brokerage link that I'm using can be found in the description down below. If I want to create a rolling order, what I could do is essentially roll this out. Let's say I went to, let's say middle of October as just an example. I'd have to look closer at this to decide if I want to do this or not. But what I could do is I could go out and let's say I want to just keep the same strike price even. I could do the 200 or let's just do the 210. What this would do is you can see I've rolled it further out in expiration and just added a little bit to the strike price higher. And you can see I'm getting offered here $1.88 in premium. So I would collect $940 as a net credit from doing this rolling option. All I'm doing is I'm saying if the stock price jumps past those levels, I'll sell the shares in exchange to collect $940. Now, they're kind of free. You might be saying, is this free money? Is there any risk here? There actually is no additional risk when selling a covered call. The risk, quote unquote, is that if the stock were to go to $250, I would miss out on a substantial amount of those gains. But there is no inherent risk in selling a covered call against shares that I own. And if you've been watching me across my 2 YouTube channels here, my Trader Nick channel, where I create videos about what's happening in the macro market, right, indices and commodities, or this channel where I talk about individual stocks, you've probably heard that in both areas, I'm a little bit cautious on this market right now. I think there is room for this thing to chop sideways or to move lower. And so I have been selling calls or covered calls against most of the shares in my portfolio. This positions me slightly defensive in case we do continue to see a choppy market or a downwards market in the coming weeks. You can see I've sold covered calls on Delta, Robinhood, Nvidia, ExxonMobil, Lululemon, Google, American Express, Airbnb, Amazon, Tesla, and I have some out of the money puts as well that I've sold puts on. So while I'm not outright selling my portfolio, I am capping my upside in exchange for collecting some premium in case the market were to go sideways or have a little bit of a tricky time in the next few weeks. I honestly think that the market has had such a good run up, and while it could theoretically continue, I think that the risk to reward to buying a bunch of stuff right now is just not very attractive. That being said, there are some stocks that still look relatively attractive even after their rally recently in UnitedHealth Group. I still think this stock is a buy in my personal opinion. In fact, if not before, it might look more attractive now that we've started to see a potential bottoming forming in this stock. We were very oversold. We've now jumped up. So if you were to get pullbacks in the stock, to me, this looks like it might be a turnaround in the making for UnitedHealth Group. On a valuation perspective, the trailing 12-month PE looks attractive. The forward PE looks attractive. Price to sales looks attractive. Debt to equity looks normal. Revenue growth still looks healthy. To me, this stock is a buy. However, some of our technical reads are not so good. We now look a little overextended to the upside, and the trend is still on a big picture, still to the downside. So I'd love to see this stock show a little bit of strength now that we've had this big pop. I would love to see, if you get a pullback into this gap, open area, if we were to pull back into that area, I'd love to see the stock price start to find some support and move into a higher low, higher high sequence. I definitely think that could signal that you may be in the formation of a longer term sustainable bottom in the stock. The problem is we've seen this a couple different times where the stock has a big drop. It looks like it's forming a bottom only to take that out once more. And when it does, it's been dropping very violently and very suddenly. Like just take a look at this peak to trough move. That's a 60% move almost in the stock price. From there to there, it's a 61% drop. So the stock has been in free fall. So I'm a little skeptical to get overly bullish on UnitedHealth Group, but I do think it is worth a look. And for me personally, I am looking to buy shares in the stock if we do get a pullback. Here's an updated look at Palantir since we filmed the beginning of this video, down 7% today. My goodness. Fortinet stock is another one that I've been watching a lot recently. I own a good bit of shares of this stock, and I do think that, it's had a really ugly drop off that I personally think was a little overdone. We've seen a little bit of bounce back in the stock. And depending on what happens in the broader market, if things hold up, I think Fortinet could stage a continued recovery move. Nvidia down now 1.86%. Coinbase continuing to be under pressure here recently, down another 2% today. And here's a look at Robinhood, which is again a stock that I own shares in, but also have covered calls on. I own 600 shares of Robinhood, which sounds kind of crazy now because when I bought the shares, they were only 40 bucks, but the stock price has ballooned up to $112 per share. The issue that I'm facing now, that I've explained in a couple videos, is that I've sold calls against my shares, and the stock price has continued to go up and away. Now, I've struggled with this and taken a couple losses on this already, but I sold fresh calls a couple weeks ago, but I sold fresh calls here to collect a little bit more premium. I sold a $98 strike price, which is in the money calls. I sold the in the money calls here, collected $21 in premium. And so if the stock price were to move sideways or even come down to that level, I have a lot of downside protection in the stock and actually could make a good gain on the calls that I sold here. That being said, I'm not looking for the full premium. If I can get something like 40 or 50% of max premium on this, I will likely sell out of this short call position.